You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Hi there again, this is Mark Sebastian with the Options Insider Network. I'm joined by Andy Nybo, head of derivatives at the TABB Group. And Andy, thanks for joining me.
Well, thanks for having me today. It's great to be here.
So that was a fascinating combo of presentation and panel that I just watched. The first piece, it was interesting. The way you started out was very, I don't want to say dark, but it certainly didn't paint the best picture for where liquidity is going in our business. So what's going on?
Right, so there's challenges with our options markets, and part of it has to do with the complexity of the market structure. Part of it has to do with the market environment, the trading environment we've seen over the past 2, 3, 4 years. An incessant bull market is a tough environment to trade, particularly if you're in the business of managing risk. Volatility levels have been flat for a couple of years, so trading opportunities are few and far between. With that said, it doesn't mean that there's not opportunities out there for the buy side. I talk about the lack of liquidity in my presentation today. Yeah, in some sectors of the market, there is a lack of liquidity, but in other sectors, there's plenty of liquidity. The concentration of liquidity, unfortunately, is in the top 100 names, in the index products, in the near-term expirations, so weeklies have a lot of liquidity.
Yeah, so, where does liquidity really start to drop off in your research? Is it at 60 days? Is it at 6 months? Is it into the leaps? So where are the weaknesses in liquidity?
You can almost look at the curve of the options expirations, right? So the front weekly has a lot of liquidity, particularly as you get to expiration on Friday, Saturday. That volume just ticks up and it becomes a deep and very liquid market with two-way trading going right into expiration. When you go out the next week, 3 weeks, the regular expirations, there's still plenty of liquidity. There's lots of trading interest, particularly at the money options. It's when you move beyond 2, 3 months out, 6 months out, at the money options, deep in the money options, whether it be put or calls, there tends to be very wide market spreads, and there's a lack of displayed interest on the screens.
Yeah, so one of the interesting things in liquidity, you talked about the fragmentation. You mentioned there's 13 exchanges and 2 more coming along the pipe potentially?
Potentially 1 or 2 more by the end of this year.
So how do those break up in terms of their different modeling? There are probably 2 or 3 main ways that exchanges operate. How does that break up?
So there's really 2 different market models, so to speak. There's a pro rata traditional market model and the maker-taker model, price-time priority model for the other exchanges. So many of the holding companies have both models under their umbrella, but it attracts different type of flow, different type of trading interest, and different type of market makers.
So, bringing this to the retail trader, has this fragmentation beneficial in general do you think to retail traders, or do you think it's detrimental on the retail side? I don't know how much work you do in the retail side.
Well, I do a lot of work on the retail side. I mean, retail traders, retail investors have never had it so good, frankly. They're getting more market information. Their commissions are low. The fees they pay are very low. The type of services that the brokers are providing to the retail clients are tremendous. Institutional quality trading platforms, market data platforms, pro trading platforms. So the retail investor is getting price improvement. They're getting great data. They're getting great support from their brokers, both from technology as well as phone support. So the retail investor has really benefited from the competition at the exchanges and the competition from the brokers themselves.
Well, that's wonderful. So moving back toward the institutional side, one thing that kind of struck me in your surveying was that a lot of the asset management side, they're less price sensitive in terms of how much the broker is charging them than maybe they were even a few years ago, and they actually care a lot more about market research and other factors being provided them. What do you think? Where do you think that's coming from?
Right. So when you talk about commission sensitivity, I guess, as opposed to price sensitivity, commission sensitivity, institutional investors are happy to pay for service. They're happy to get good pricing. They're happy to get good services and pay for it from their brokers. That's a different type of trading perspective if you are using capital, if you're using research, if you need access to company management, if you need a full suite of services from your broker, then you should have to pay for it. As opposed to more quant, stat arb type funds that are trading much higher volumes, much more frequently, and are effectively price sensitive accounts. They are looking to get smaller amounts of edge. They trade more frequently and they trade in bigger size, so they want lower commissions because any kind of commission difference in what they pay hits their bottom line, hits their return on that fund.
All right, so aside from potentially getting a few more exchanges, what else do you foresee kind of major events coming down the pipeline? This is between us, it's between us and the listener, but here at this conference, part of me in the back of my head is wondering whether the CBOE is going to announce a weekly VIX contract while we're here. On top of the fact they've just added this 12 out, they're now trading the S&P options for 12 hours now?
Right, extended hours.
And the extended hours. So, you were telling me you're seeing lots of interest in the extended hour trading out of your clients. Have you heard any feedback from clientele on, would they be interested in a product like that? The VXST, super interesting in theory, has fallen a little flat. So, what are your thoughts on, this, obviously the extended hours, and then, do you think the industry has an appetite for a weekly VIX contract?
Sure. So extended hours SPX, extended hours VIX trading opens up, a suite of volatility products to the world. It opens up a suite of volatility products to overnight trading hours, morning or evening trading hours, when events do happen, political events happen, natural disasters happen. So it's a great tool for institutions to be able to manage their risk outside normal U.S. market hours. It opens it up internationally for investors in Asia or Europe that are managing their portfolio and managing their risk exposures. So I think there's a lot of opportunity there. The one question is what happens if there is an event and everybody wants to go the same way? There's going to be a one-sided pool of liquidity that's trying to get in or out of risk exposure. In terms of a weekly VIX product, I think the attraction of volatility products themselves have become huge and a big part of the growth story behind the CBOE. There is absolutely global interest in trading volatility products, and they've seen this tremendous growth in times of volatility that effectively have been flat for the past 2 years. Sure, there's been a number of spikes, and you see options trading and VIX futures trading spike during those periods. But what happens when we go into a prolonged period of increasing volatility, when QE2 ends, or when there's other macro stimulus policies from the government that changes the economic environment, the trading environment? So there's huge potential there. And a weekly VIX product that allows funds to manage weekly volatility exposure instead of the regular expirations now, I think there's tremendous growth opportunity there. The complexity of that product set and calculating the VIX and the volatility measures around that is one of the challenges.
All right, last question. Have you gotten a look at the box product, the volatility product the box is looking at, and do you have any thoughts on it?
We're actually working on some research around that space. We always keep an eye out for new product launches, and this is one that looks pretty interesting. So don't have any comments yet, but certainly happy to come back and talk about it once we see a little bit of history there.
So pay attention to the TABB Group and TABB forums and something might pop up that somebody wants to look at. So,
Absolutely.
Andy, thank you very much for your time. I really appreciate it. Have a great rest of your week.
Great, thanks, and thanks for having me here today.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.